Are all barrels equal? I mean, the value of a barrel of oil or a cubic feet of gas will vary. It will vary depending on the costs to find and develop and produce. For example, deep water, very, very expensive oil and gas to produce. Onshore might be very inexpensive. The margins could be completely different. Plus, of course, the capital outlay, the capital expenditure of one compared to the other will be dramatically different. Then we have heavy oil versus light oil. Much more expensive to produce heavy oil, from an operating cost point of view, than light oil. Sweet gas versus sour gas. Sweet gas is gas that has very little inerts. It's very easy to produce. It requires very little processing. Sour gas may well have hydrogen sulfide, very expensive processing and all sorts of safety issues related to it. And region by region also will vary. Recently, I think Australia has been in the press because of the high costs of its LNG projects. Much cheaper to do similar projects in the US than it is in Australia, for example. And of course, price that we get for our products in an oil and gas company will vary depending on the quality of the product. Light oil versus heavy oil, liquids-rich gas versus light risk, we actually get more money for. And also, of course, depends on location and region. And then finally, of course, we got royalty. How much are we actually paying to the government? What part of our production do we actually pay to the oil or to the host government? And even some regions may pay higher royalties than others. In the US, when the shale gas plays were hot plays, certain hot areas were actually paying higher royalties than other areas, again to try and encourage investment in other regions in the US. So if we say that not all barrels are created equal, what do we think about the statement that a lot of oil companies, managing directors and chairmen of the board in their statements often make the statement that X and XY companies proudly announces a reserves replacement ratio of 100%. So they're actually reporting what they believe is a good thing. And perhaps in most cases it is a good thing. But what does that actually mean? Well, firstly, what are we talking about when we talk about reserves replacement ratio? What we're saying is that when it is 100%, the oil or gas company has replaced all of its previous 12 months production. Remember how I said, as we produce, we're taking reserves out of the ground, the reserves will decrease. So what an oil and gas company wants to try and do is it wants to replace that. It wants to get back to what it was before, ideally even grow, even get 120 or 150% reserves replacement. But the issue comes in when you think about value, because what if the production was originating from high value, high margin reservoirs and regions, and all the new reserves are in low value, low margin reserves and regions? So effectively what you're doing is you're replacing potentially high value reserves with much lower value reserves. So the reserves are not changed, but the value has. So something we've always got to remember. Now, a lot of recent reserves growth in oil and gas companies have come in the unconventionals area. Generally speaking, these are relatively low margin. So if all the reserves replacement is coming from low margin and all the production is coming from high margin, then clearly there is something going on in terms of value there. So beware, some barrels are more valuable than others.
You should look a lot on the quality of the reserves as opposed to the quantity of that. Of course, quantity also being important. With the oil price crashing to $50, $60 a barrel, some of the subsea reserves would really be underwater in both sense of the word. So how do you evaluate that for companies which has high exposure? Say, for example, one of those companies in the limelight these days, Petrobras, which has quite a lot of exposure there. How do they mark that down? And in terms of the contingency reserves that you said, the switching back and forth, is there a discount factor on those proven reserves as well? How they quantify that?
Okay. I mean, companies that have big exposure to the lower oil price, I mean, how you value that, you obviously have to put some sort of value on that exposure, and how you calculate that will depend on what information you have to go ahead and do it. I mean, first of all, you've got to understand, I suppose, the resource base that a company has. So if a lot of a company's reserves are deep water, yet to be developed type of reserves, immediately you're starting to put up a bit of a red flag here and say, whoa, at these lower oil prices with those very high capital costs, is that a company that maybe I need to look at a bit more carefully? The same with, I would suggest, some of these unconventional resources. Again, they're pretty marginal. At the current oil prices, perhaps there's something again that you need to look at. Of course, going forward, this is a moment in time. Going forward, of course, if the price does come back up, as people seem to expect, then are you looking at the short term or are you looking at the longer term? Longer term, they may be fine. They're just probably going to defer some of their development for a period of time, but it still will have value in due course.
The second one was in terms of swapping the contingency reserve, right? So as the price fluctuates, did I understand it correctly? You might be swapping them in or out of contingent reserves.
Well, that will happen, of course, as projects become uneconomic, then they will, by definition, move into contingent resource. Now, I teach reserves courses, and one of the things that I always strongly recommend to oil and gas companies is that they have a subcategory which is related to projects that are purely in the contingent resource simply because of price. As they all look fine, they're good, technically strong, they just need a higher price. And you need to keep a track of that. Now, whether those companies will actually report that separately, that's of course up to them. They may not. They may or may not. In this environment, they may want to. They may want to say that our reserves have gone down by X million barrels, of which X percentage is purely due to price. That might be something that might be quite useful for an oil and gas company to inform investors. And then, of course, if you strongly believe the price is going to come up, then you can quite reasonably argue that those are all going to come back into reserves when the price goes back up again.
Sorry to be at risk of being flippant, but is there a possibility that the same reserves constantly are upgraded from contingent into reserves? In other words, they announce a 10 million barrel increase every 6 months. It's just that in the meantime, they've actually downward adjusted it into contingent resources.
Whoa,
So in other words, they make a big deal of when they do upgrades, but not downgrades.
Let's think about reserves. Companies declare their reserves annually. All right, so they're part of the annual reporting cycle. So when you are comparing previous numbers, you are comparing to what was previously published. Okay, so there's no kind of halfway in between, let's just flick a whole lot into contingent resource. There's one process, and that occurs at year end.